Usually when we talk about a science or like a mathematical discipline, there's this expectation of just absolute precision.
Right.
Think about structural engineering, right? An engineer designs a bridge, calculates the exact load-bearing capacity of the steel girders, points at the blueprint, and just states as a matter of indisputable fact, it will hold exactly this much weight.
Yeah, because physical sciences deal with constants. It's binary. I mean, it's measurable. The physics of steel don't suddenly change because the steel read a bad headline in the Wall Street Journal.
Exactly. The bridge holds or it breaks. That's a clean calculation. And we, as humans, we crave that. We want things to be visible, categorized, and, perfectly predictable.
Absolutely.
But then you step into the world of finance, specifically the realm of investing, and that precision engineering just goes entirely out the window. We're looking at a landscape of future returns that is incredibly murky, subjective, and just, well, dynamic.
It is the absolute definition of navigating the unknown.
Yeah.
You aren't dealing with static concrete. You're dealing with probabilities, global events, and most importantly, the aggregate psychology of millions of human beings reacting to the ever-present specter of uncertainty.
And that uncertainty is exactly why we're here today. I want to welcome you, the listener, to this incredibly focused deep dive. We know exactly who is listening right now. You are an MBA student, and you are staring down the barrel of a major career-defining exam.
And the security analysis and portfolio management.
Exactly. Specifically, we are tackling Unit 4, Analysis of Risk and Return.
It's a notoriously dense unit, too. Like, this is the kind of material that doesn't just test your ability to memorize formulas. It tests your fundamental intuition about how capital markets actually operate.
Right.
It makes or breaks your final grade and, honestly, your credibility in an interview down the line.
So, our mission today is singular. We are going to completely demystify this text. By the time we're done here, our goal is that you will be able to effortlessly recall the mechanics behind the formulas, the conceptual architecture of the markets, every tricky definition.
The subtle nuances professors love to use to trap you in multiple choice questions.
Yes, those tracks are brutal. We have a robust stack of source material covering the unbreakable relationship between risk and return, the specific taxonomy of threats to a portfolio, the complex mathematics of portfolio blending, and the risk-adjusted models used by the institutional pros.
And we're going to do it by focusing on the why and the how. Because, if you understand the mechanism behind the math, you won't ever need to blindly memorize a string of variables.
Okay, let's unpack this. Let's start with the absolute core theme of the entire unit. The foundation of everything we're going to discuss today is this. Risk and return are two sides of the exact same coin.
Yeah, you cannot have one without the other.
Right.
That is the foundational rule of finance. Usually, higher risk equals higher expected return, and conversely, lower risk equals lower expected return. The reason for this is deeply rooted in human psychology, which the text explicitly points out. Investors are inherently risk-averse.
Now, in an MBA context, we have to be really precise with that term. Risk-averse doesn't mean investors are paralyzed by fear and just refuse to take risks.
Right. Obviously, equity markets exist, so people are definitely taking risks.
Exactly. So what does it actually mean for asset pricing?
It's a pricing mechanism. It basically means that if you present a rational investor with two different investments and both offer the exact same expected return, let's say 10%, the investor will always choose the investment with more certainty.
The safer bet.
The one with a tighter variance of outcomes, yeah. Therefore, to convince an investor to deploy capital into a riskier, more volatile asset, the market must offer them a higher expected return. It's essentially a bribe.
A bribe, I like that.
The market compensates you for the anxiety of taking on the possibility of a permanent loss of capital.
Right, they demand a premium. But here is the critical pivot, and I really want to highlight this because this is exactly where professors love to set traps. What does a higher expected return mean for the actual realized return?
I am so glad you brought that up because confusing the two is a classic rookie mistake. Listen closely to this distinction for the exam, okay? A higher expected return absolutely does not guarantee a higher realized return.
If it did, it wouldn't be a risk.
Exactly. If it did, it wouldn't be risk. Risk, in the context of modern portfolio theory, is defined strictly as the uncertainty or the dispersion of actual returns from the expected average.
Meaning risk isn't just, losing money.
Right. This uncertainty means there could be negative surprises, sure, shortfalls where you lose capital, but risk is symmetrical in standard models. It also means there could be massive positive surprises where the portfolio wildly outperforms. Risk is just deviation from the expected path in either direction.
I like to think of expected versus realized return like a sophisticated meteorological model. You look at the forecast, and the supercomputer says there's a high probability of a beautiful, sunny, 75-degree day based on historical patterns and current atmospheric pressure.
Right.
You expect a sunny day. That forecast is your expected return. But the atmosphere is a chaotic system. That inherent uncertainty, that is your risk. When you actually step outside, a freak, unpredictable microburst might happen and you get absolutely soaked.
You expected sunshine, you got a downpour.
Getting rained on, that is your realized return.
That's a highly accurate way to visualize it, honestly. The forecast is your ex-ante return.
Ex-ante?
Yeah, ex-ante. The expectation formulated before the event based on probabilities. The rain is the dispersion from the mean, the actual realized ex-post event. Ex-post meaning after the fact. In finance, the wider the range of possible weather outcomes, from blazing heat to a blizzard, the higher the inherent risk of that particular asset.
So before we can start calculating the standard deviation of this financial weather forecast, we have to know exactly how to classify the different atmospheric threats.
We need a taxonomy of risk.
Yes, the source text spends a significant amount of time breaking down specific types of risks. Understanding these definitions, and more importantly, how they interact, is just non-negotiable for the exam.
Absolutely non-negotiable.
Let's start with the granddaddy of them all, the ultimate binary in finance, the divide between systematic risk and unsystematic risk. I'll take the first one. Unsystematic risk. This is the uncertainty that is tied strictly to a particular company or a specific industry. It's the micro-level stuff.
Give me a real-world scenario.
Say you invest heavily in a cutting-edge tech company. Everything looks great, but suddenly, over the weekend, their star CEO is implicated in a massive fraud scandal and abruptly resigns.
Ouch.
Or you invest in a legacy manufacturing firm and a freak lightning strike burns their primary distribution center to the ground. Those are terrible, value-destroying events, but they only affect that one specific company. They don't drag down the entire S&P 500.
Right. And here's the exam hook you need to write down. Test makers will aggressively rotate synonyms for unsystematic risk to see if you actually grasp the concept or just, memorize a flashcard.
Oh yeah, they love doing that.
Unsystematic risk is the exact same thing as unique risk, firm-specific risk, and most importantly, diversifiable risk.
Diversifiable, meaning you have the power to structurally eliminate it from your portfolio. We will get to the math of how that magic trick works shortly, but the name implies its weakness. Now, on the other side of the ledger, we have systematic risk, which is broadly referred to as market risk.
This is the macro-level threat. This is the risk faced by all investors simultaneously across almost all asset classes. You cannot escape it just by picking a different stock in a different sector.
We're talking big stuff here.
Massive systemic shocks. A sudden, sticky spike in global inflation, the outbreak of a major geopolitical war, a severe, cascading economic recession, broad, aggressive changes in macroeconomic interest rates set by central banks. When these forces sweep through the economy, the rising tide lowers all ships.
And the synonyms they'll use to disguise this on the test.
You will see systematic risk, referred to as beta risk, or non-diversifiable risk. You cannot diversify it away because it is baked into the very fabric of the economic system. When retail investors talk about the stock market being risky today, they are almost exclusively feeling the weight of systematic risk.
Which brings us to the master equation outlined in the text. This is a conceptual formula you need to be able to manipulate in your sleep. The text presents it in 3 identical ways, using the vocabulary we just discussed.
The total volatility of a stock is simply the sum of its parts. So total risk of a stock equals general risk plus specific risk.
Which is identical to saying total risk equals market risk plus issuer risk.
Exactly. Which is also exactly the same as total risk equals systemic risk plus non-systemic risk. If you see any combination of those pairs, the examiner is just testing your understanding that a stock's total volatility is a cocktail.
Cocktail of macro and micro.
Yes. It's made up of the macroeconomic forces it cannot control, mixed with the microeconomic forces unique to its own business model.
But the text doesn't stop at the big binary. It dives into a nuanced, highly specific list of risks. Let's do a deep exploration of these. I don't just want to define them. I want to understand the mechanism of how they destroy value and how the text says an MBA student should mitigate them.
That's good.
Let's start with political risk.
Okay, political risk is the danger caused by sudden shifts in the legal or political regime of a jurisdiction. It's not just who won the election. It's about the rules of the game changing after you've already placed your bet.
Like changing the goalposts.
Exactly. Imagine a foreign government suddenly deciding to nationalize the telecom industry, seizing assets without fair compensation. Or, closer to home, a new administration retroactively changing the corporate tax structure, instantly wiping out the projected free cash flow of your holdings.
It's the risk of the referee changing the score mid-game. Next is inflation risk, which I like to call the silent thief of wealth. It's the risk that your investments, especially large cash positions or fixed-rate bonds, won't grow fast enough to maintain your purchasing power against the rising cost of living.
The mechanism here is insidious because your nominal account balance might be going up, giving you a false sense of security. But if you earn a 3% yield on a bond and real-world inflation is running at 6%, your real return is negative 3%.
You're actively losing money.
You are actively getting poorer every single day you hold that asset.
And the textbook mitigation for this.
The text specifically points to inflation-protected treasury bonds, like TIPS in the U.S., where the principal value is contractually indexed to inflation metrics, offering a structural shield.
Okay, let's talk about financial risk. Now, this one is entirely tied to a firm's internal decisions, specifically its capital structure and its appetite for debt.
Exactly. Leverage is a magnifying glass. If a company funds its operations purely with cash generated from the business, it has very low financial risk. But if a company borrows heavily, issuing massive amounts of corporate debt to fuel expansion, its financial risk skyrockets. Why? Because debt introduces mandatory, inflexible interest payments.
Right. The bank doesn't care if you had a bad quarter. They want their interest payment.
Yeah.
If revenues dip, the massive debt burden can quickly force a highly leveraged company into insolvency, wiping out the equity holders completely.
Moving on to management risk. This applies when you delegate your capital to an active fund manager. It's the risk that, despite their fancy credentials, they simply make terrible asset allocation decisions.
Or they just have a bad decade.
Or perhaps their specific investment style, like deep value investing, goes out of favor for a decade, causing them to severely underperform a basic benchmark index.
And the mitigation strategy the text offers for management risk is brutal but effective. Take the human out of the loop entirely. You avoid management risk by allocating capital to passively managed low-cost index funds that simply track the market rather than trying to outsmart it.
Now we hit one of the most mechanically important concepts in fixed income: interest rate risk.
This is huge. The text spends a lot of time here. Explain the mechanism behind this because it trips up a lot of students. Why do bond prices fall when interest rates rise?
Think of it like a seesaw. There is a rigid, mathematical inverse relationship between existing bond prices and new market interest rates. Let's say you buy a brand new 10-year bond yielding 2%. A year later, central banks raise rates to fight inflation, and now brand new 10-year bonds are being issued at 5%.
Okay, so I'm stuck holding a 2% bond in a 5% world.
Exactly. Now, if you want to sell your 2% bond on the secondary market to raise cash, why would any rational investor buy it from you when they could just go buy a new one yielding 5%?
They wouldn't.
They wouldn't. The only way you can convince someone to buy your inferior 2% bond is if you dramatically slash the asking price. You have to discount the price of your bond so steeply that the combined 2% coupon plus the capital gain they get from buying it at a deep discount equals exactly a 5% total yield.
The seesaw mechanism. Rates go up, existing prices must go down to compensate, and there's a vital exam hook here regarding maturity.
Yes. The text emphasizes that interest rate risk is significantly greater for bonds with longer maturities. This is related to the concept of duration. A 30-year bond will experience a massive price drop compared to a 2-year bond when rates tick upward, simply because the investor is locked into that inferior yield for decades rather than months.
The pain of missing out is compounded over a much longer horizon.
Exactly.
That makes perfect logical sense. Next up is credit risk, which is straightforward. It's the risk of default. The corporation or the municipality that issued your bond mismanages their finances, goes bankrupt, and simply stops paying your interest or fails to return your principal.
Then we have call risk, which is a fascinating corporate finance maneuver. It's the risk that a bond issuer might legally decide to redeem or call a bond away from you before it actually matures.
Now, why would a company do that?
For the exact same reason a homeowner refinances their mortgage. If a company issued debt 5 years ago at 8%, and today the prevailing market interest rate drops to 4%, The company realizes they are drastically overpaying you.
Oh,
If the bond contract allows it, they will call the bond, meaning they force you to take your principal back early and then they immediately issue new bonds at the cheaper 4% rate to pay for it.
which is great for the company, but terrible for the investor because it thrusts them immediately into reinvestment risk.
Exactly, they are joined at the hip. Reinvestment risk is the danger that the cash flows you receive from an investment like bond being called early, or even just your regular semi-annual coupon payments, cannot be reinvested into the market at that same high original rate of return.
You were enjoying an 8% yield, the bond gets called, you get a pile of cash, but now the market is only offering 4%. Your income stream is structurally impaired.
Precisely. Let's briefly touch on currency risk. In a globalized market, if you are an investor in Mumbai buying U.S. tech stocks, you are exposed to the daily fluctuations in the exchange rate between the rupee and the dollar.
Right.
If the U.S. stock performs brilliantly, but the dollar severely weakens against the rupee, your actual realized return when you convert that money back home might be zero or even negative.
And finally, the text contrasts two deeply personal opposing risks in financial planning: longevity risk versus shortfall risk.
They sound like synonyms for failure, but they represent entirely different structural problems in a portfolio.
Yeah.
Longevity risk is simply the risk that an investor outlives their accumulated capital. It's the danger of a portfolio being too conservative, not growing enough and running dry at age 85 when the investor lives to be 95.
Whereas shortfall risk is the risk that a portfolio fails to hit a specific targeted liability in the future. For example, a pension fund needing exactly $100 million to meet its obligations by 2030. But aggressive market drawdowns mean the portfolio only reaches $80 million. It fell short of the absolute required target.
That covers the taxonomy. If you've been following along, you now have a mental matrix of the specific mechanisms that can attack capital.
But defining the threats is only the first step of the curriculum. The core of Unit 4 isn't just naming the beasts, it's measuring them. How do we put a hard, testable number on this uncertainty? Which brings us to the mathematics of single assets.
We begin with the concept of volatility. The text defines volatility as the range of price fluctuations compared to the expected level of return. It is the raw data of movement.
Okay.
The more frequent and severe the changes in a stock's price, the more volatile it is. In traditional finance, increased volatility is the proxy for increased uncertainty, which mathematically translates to greater risk.
But volatility is a conceptual term. On an MBA exam, they demand a rigorous mathematical measurement. They want standard deviation.
Yes. Standard deviation, usually denoted by the Greek letters sigma or just S in this text, is the undisputed king of risk measurement in classical portfolio theory. It calculates how wildly the actual historical returns deviate or spread out from the average mean return of that asset.
Now, I don't want us to just read the formula out loud because hearing a string of variables doesn't teach anyone anything. Let's break down the architecture of the standard deviation formula. Why is it built the way it is?
Think of it as a multi-step filtration system for data. The first step is to find the average return. Then you take every single historical return in your data set and subtract that average from it. This gives you the raw deviation, how far off the mark each specific period was.
But here's the problem. If you have a year where the stock went 10% above the average and another year where it went 10% below the average and you just add those raw deviations together, they cancel each other out to zero. It would look like the stock had zero risk, which is obviously false.
Precisely. And that is exactly why the formula requires you to square each of those individual deviations. Squaring a negative number makes it positive. By squaring all the deviations before adding them up, you ensure that every single swing, whether it was an explosive gain or a catastrophic crash, adds to the total measurement of volatility, captures the true magnitude of the chaos.
Okay, so we've added up all those squared deviations. Now we have to divide that massive number to find the average variance. But the formula doesn't divide by n, the total number of observations. The formula divides by n minus 1. Why?
This is a beautiful piece of statistical conservatism known as Bessel's correction, dealing with degrees of freedom.
Degrees of freedom.
Right. When you are working with a small sample size of historical data, say just 5 years of returns, you don't possess the entire population of data for that company. By dividing by a slightly smaller number, n minus 1, you artificially inflate the final result slightly. It builds in a margin of safety. It prevents you from underestimating the true risk when you only have a limited window into the asset's history.
Finally, because we squared everything earlier, our unit of measurement is distorted. So we take the square root of that whole final fraction to bring the number back down into a recognizable percentage. And that final number is your standard deviation.
Exactly. It's a brilliantly constructed mechanism to quantify historical chaos.
But history is only half the battle. The text also introduces probability distributions to measure future expected risk.
Right. When analysts look forward, they build probability distributions. They map out all possible future scenarios, a recession, a boom, stagnation, and assign a decimal probability to each based on their research.
The text introduces the term ex ante return here.
Ex ante means before the event. To calculate the ex ante, or expected return, you don't just guess. You calculate a probability-weighted mean. You take the estimated return of each possible future scenario, multiply it by its probability of occurring, and sum them all up. It gives you the single, statistically most likely outcome to use in your models.
Now, here's where we hit a massive conceptual trap. This is a concept that fundamentally trips up even seasoned investors. We need to talk about the difference between an annual return and an annualized return. They sound like they should be the exact same thing, but mathematically, confusing the two will destroy your portfolio projections.
It is a critical distinction. An annual return is a simple, literal measurement over one specific calendar year. For January 1st to December 31st, what did the asset do? That's it.
But an annualized return is a completely different beast.
Yes. Annualized return is a smoothed-out, standardized metric. It takes a return achieved over a multi-year period, or even a period shorter than a year, and mathematically converts it, annualizes it, so you can compare it apples to apples with a standard one-year rate.
And the reason we have to do this complex math is because simple arithmetic averages lie to us when it comes to investing. Let me give a brutal example. Say you invest $100. Year one, the market crashes and you lose 50%. You are down to $50. Year two, the market roars back and gains 50%. What is your simple average return? Negative 50 plus positive 50 is 0. Divide by 2 years, your average is 0%. You should be back to even, right?
But you aren't, because a 50% gain on your remaining $50 only gets you back to $75. You're still down 25% on your initial capital, even though the simple arithmetic average of the 2 years is 0.
Exactly. The simple average completely ignores the sequence of returns and the reality of a shrinking capital base. This is why the text introduces the geometric average for calculating annualized returns. It accounts for compounding.
Let's look at the mechanics of the geometric average using the mutual fund. A Barilla returns data from the text. Over 5 years, the fund had sequential returns of 3%, 7%, 2%, 12%, and 8%.
To find the annualized return, we don't just add those up and divide by 5.
No, we convert each percentage into a growth factor. 3% growth means your capital multiplied by 1.03. So we chain them together. We multiply 1.03 by 1.07, by 1.02, by 1.12, by 1.08. When you multiply all those sequential growth factors together, you get the total cumulative growth over the 5 years, which the text notes is 135.97%.
And then to annualize it, to find the smooth yearly equivalent, you take that cumulative result and raise it to the power of 1 over n, where n is the number of years, so the fifth root.
Exactly. When you take the fifth root of that cumulative growth and subtract the 1 out, you are left with an annualized return of 6.33%. That geometric average is the true, accurate representation of your compounded wealth creation.
The text highlights this beautifully with the Nifty 50 data from 2006 to 2016. It shows how an initial investment of 1 lakh rupees in 2008, right during a massive crash, eventually grew to over 2.7 lakhs by 2016. But an investment made just 2 years later, in 2010, when the market was much higher, barely grew to 1.3 lakhs by the same end date.
Which proves why looking at single-year returns is virtually useless for long-term planning. The specific year you deploy capital vastly distorts the outcome. Annualizing the return over the entire decade smooths out the chaotic entry points and gives analysts a baseline metric to compare the Nifty 50's true performance against entirely different asset classes like real estate or sovereign bonds.
So we've established how to measure the chaotic volatility of single assets. We see how dangerous a single stock can be, which begs the million-dollar question for any portfolio manager. If individual equities are this volatile, how do we structurally protect our capital? How do we build defense?
We use the only free lunch available in finance. Diversification. Remember, unsystematic risk. The company-specific threats, like the factory burning down. The text proves that by holding a broadly diversified portfolio of risky assets, spread across entirely different sectors and geographies, you can mathematically eliminate unsystematic risk entirely.
Let's explore the mechanism of that. How does holding more risky things make me less risky?
It relies on the law of large numbers and uncorrelated cash flows. Think of it this way. You own a massive global airline. Suddenly, geopolitical tensions cause the price of crude oil to triple. That is a terrible random event for your airline. Their fuel costs skyrocket, profits tank, and the stock crashes.
So I lose money.
You do, if you only own the airline. But if you hold a broadly diversified total market index, you don't just own the airline, you also own the multinational oil refinery.
Yeah.
That exact same macro event oil tripling which crushed your airline results in record-breaking windfall profits for your refinery stock. The catastrophic loss in one asset is perfectly neutralized by the massive gain in the other. When you extrapolate that across thousands of companies, the specific micro risks are completely diversified away. You flatten the volatility curve.
Okay, I have to play devil's advocate here on behalf of the MBA student. If risk and return are intrinsically linked, and we just perfectly executed a strategy to eliminate all this unsystematic risk from our portfolio, don't we inherently lose out on the expected returns associated with taking those risks?
This is perhaps the most critical conceptual trap on the exam, and the answer is definitively no. You do not lose expected returns.
Wait, why not?
Because of the efficient market hypothesis. In a rational, efficient market, there's no reward for incurring unsystematic risk. The market is not a charity. It will not pay you a premium for taking a risk that you could have easily, cheaply avoided through simple diversification.
So the market assumes everyone is diversified.
Exactly. The market only compensates investors via higher expected returns for taking on systematic risk, the macro risk that nobody can hide from. Therefore, modern portfolio theory dictates that you must diversify as broadly as possible to kill off uncompensated specific risk, leaving you exposed only to the systematic risk that actually drives wealth creation.
That is a fundamental paradigm shift for a lot of students. Only systematic risk gets paid. Now, while we are talking about creating wealth, let's look at how we measure the historical success of these assets. The text outlines the formula for calculating total historical return, and it's elegant in its simplicity.
Total return measures the absolute reality of what an investment generated for you over a period. The text formula is cash payments received plus price changes divided by the beginning price of the investment.
Let's put this into a real scenario. Imagine an equity stock. You buy it at the beginning of the year for 120 rupees. Over the course of the year, the company pays out a cash dividend of 4.80 rupees per share. By the end of the year, the stock has rallied, and the market price is now 138 rupees.
The calculation is straightforward. Your cash payment is 4.80. Your price change is the ending price of 138 minus your beginning price of 120, which is a gain of 18 rupees.
Right.
Add the cash and the gain together. 4.80 plus 18 equals 22.80 total value created. Finally, divide that 22.80 by your initial 120 rupee investment. That yields 0.19 or a 19% total return.
And what's crucial for the exam is recognizing how this formula cleanly bifurcates into two distinct drivers of return. The first component is the cash divided by the beginning price, in this case, 4.80 divided by 120, which is a 4% yield. That's your dividend income.
Exactly.
The second component is the price change divided by the beginning price 18 divided by 120, which is a 15% gain. That's your capital appreciation.
4% yield plus 15% capital appreciation perfectly reconciles to your 19% total return. It's vital to understand this breakdown because different investors target different components based on their tax liabilities and income needs.
So we understand single assets, we understand the theory of diversification, and we know how to calculate total return. Now we have to transition into the deep water of Unit 4. We are moving from managing a single stock to calculating the complex math of an entire blended portfolio.
The text makes a fascinating structural observation here regarding institutional scale. It notes that massive pension funds or ultra-high net worth family offices must consider the critical mass value of their portfolios.
What does that mean in practice?
It means the math changes based on your size. If a portfolio is too small, say $10,000, the sheer friction costs of trading dozens of individual stocks brokerage fees, bid-ask spreads, will destroy your returns. You lack critical mass. You are better off buying a single mutual fund.
And if you're too big?
Conversely, if you are managing a $50 billion sovereign wealth fund, your portfolio is massively too large. You run into price impact issues. You can't quietly buy into a mid-cap stock. The mere act of your institution trying to buy millions of shares drives the price up against you before the order even fills.
It's the gravity of massive capital distorting the market it's trying to participate in. But for the core exam calculations, we assume a frictionless market. We need to calculate the portfolio expected rate of return.
Thankfully, this is one of the most intuitive formulas in the unit. The expected return of portfolio is simply the weighted average of the expected returns of every individual asset inside it. You multiply the expected return of the asset by the percentage weight it occupies in the overall portfolio and sum them up.
Let's run a classic textbook scenario. Mr. Amir's portfolio. He holds 2 stocks, total value of $100. Stock A is $40 of the portfolio, so a 40% weight, with an expected return of 15%. Stock B is $60 of the portfolio, so a 60% weight, with an expected return of 20%.
The calculation is just 15% return times 0.4 weight plus 20% return times 0.6 weight. That's 6% plus 12%, giving the total portfolio an expected return of 18%.
I want to pause here and offer a massive warning for anyone following along directly in the source text. In one of the specific illustrations provided in the reading material, there's a typographical alignment error where the weights and the returns of the 2 stocks get swapped in the printed solution line, resulting in a 17% answer instead of 18%.
That is a phenomenal catch, and it highlights a broader truth about finance exams. Never blindly trust a printed number if it violates the fundamental architecture of the formula. Always map the specific weight to its specific asset return.
Now, we must move to the undisputed heavyweight formula of the entire unit, calculating portfolio risk. Let me warn the listener right now. This is the concept that separates the A grades from the C grades. Portfolio risk is absolutely not just a simple weighted average of the individual standard deviations.
Exactly. If portfolio risk was just a weighted average, diversification wouldn't work. The risk of the portfolio is specifically mathematically less than the sum of its parts.
Let's break down the architecture of the 2-stock portfolio risk formula. It looks terrifying on the page, a massive equation under a giant square root umbrella, but it's actually built of 3 very logical components.
Let's deconstruct it. Part 1 of the equation simply accounts for the isolated risk of stock A. You take the weight of stock A, square it, and multiply it by the variance of stock A. Part 2 does the exact same thing for the isolated risk of stock B.
But if we just stopped there and added those together, we'd essentially just have a weighted average. Part 3 is where the magic of modern portfolio theory actually happens.
Part 3 is the covariance term. This is the interaction effect. It calculates how these 2 assets behave relative to each other when stressed. You add 2, multiplied by the weight of A, multiplied by the weight of B, multiplied by the standard deviation of A, multiplied by the standard deviation of A, multiplied by the standard deviation of B, multiplied by the correlation coefficient.
Let's zero in on that concept, covariance and the correlation coefficient. Forget the variables for a second. What is this actually measuring in the real world?
Think of covariance like 2 dancers on a stage. If they're moving in perfect sync, stepping in the same direction at the exact same time, they have highly positive covariance. In a portfolio, if both your stocks crash simultaneously every time the market dips, they have positive covariance. They offer very little protected diversification.
They're just amplifying the risk.
Right. If there is absolutely no pattern to their movements, one dances a waltz, the other break dances, they have 0 covariance. But the holy grail of portfolio management is finding assets with negative covariance.
When one steps left, the other steps right.
Yes, in perfect counterbalance, the text emphasizes that if you can find 2 assets with perfect negative correlation, meaning a coefficient of negative 1.0, you can mathematically blend them in a way that reduces the total portfolio risk to absolute 0.
One zigs exactly when the other zags. So when you run that massive formula, that third part, the covariance term, is actively subtracting from the total risk generated by the first 2 parts, pulling the final standard deviation number down below the weighted average.
Precisely. That is the mathematical proof of diversification. That formula proves why holding a blend of uncorrelated assets generates a smoother ride than holding any of them individually.
Okay, we know the risk, we know the expected return, we know how to blend them. This brings us to the final major frontier of the curriculum, evaluating performance. How does a portfolio manager prove to an institutional client that they are actually generating value? and not just riding a bull market, we have to introduce risk-adjusted models.
Up until now, our primary metric for risk has been standard deviation, which captures total volatility. But the text introduces a new, highly specialized metric, beta.
This is a crucial distinction. If standard deviation measures total risk, what exactly is beta measuring?
Beta is a surgical tool. It actively ignores all the unsystematic company-specific risk we discussed earlier, because it assumes the manager is already properly diversified. Beta measures only the systematic, non-diversifiable risk. It is a strictly relative metric. It measures the volatility of an individual stock or portfolio specifically against the volatility of the broader market index, like the S&P 500.
Give me the mechanics. How do I read a beta score?
The market index itself always has a beta of exactly 1.0. If you buy a tech stock and it has a beta of 1.5, it means it is 50% more volatile than the market. If the market goes up 10%, your stock should theoretically go up 15%. But if the market crashes 10%, your stock plunges 15%.
High beta amplifies the macro moves.
Yes. Conversely, a utility company might have a beta of 0.5. It's insulated. It only moves half as aggressively as the broader market. It's a defensive posture.
So, armed with standard deviation and beta, analysts built models to judge managers. The first one the text covers is the Sharpe ratio, developed by Nobel laureate William Sharpe.
The Sharpe ratio is incredibly popular because it's intuitive, and it uses total risk standard deviation as its baseline. It essentially calculates how much excess return a manager generated for every single unit of total risk they forced the client to endure.
The architecture of the Sharpe formula is simple. Portfolio return minus the risk-free rate divided by the portfolio's standard deviation. Why subtract the risk-free rate?
Because anyone can earn the risk-free rate, usually represented by a short-term government treasury bill, by doing absolutely nothing and taking zero risk. A manager only deserves credit for the return they generate above and beyond that guaranteed baseline.
Let's visualize this. Say the risk-free rate is 5%. Manager A achieves a 15% return with an 11% standard deviation. Manager B achieves a massive 19% return, but they ran a wildly volatile strategy with a 20% standard deviation. Who did a better job?
Well, let's run the Sharpe ratio. Manager A, 15% return minus 5% risk-free rate leaves 10% of excess return. Divide that 10 by the 11% standard deviation, and you get a Sharpe ratio of roughly 0.91.
Okay, 0.91.
Now, Manager B, 19% return minus 5% gives 14% of excess return, but divide that 14 by their massive 20% standard deviation, and their Sharpe ratio is only 0.70.
So Manager B made more absolute money, but Manager A is the objectively better portfolio manager.
Absolutely. The rule is higher Sharpe ratio wins. Manager A took significantly less total risk to achieve their return. They were highly efficient with their risk budget. Manager B just got lucky swinging for the fences, and the Sharpe ratio mathematically exposes that recklessness.
But the Sharpe ratio isn't the only game in town. The text pivots heavily into the capital asset pricing model, or CAPM. How does CAPM differ from Sharpe?
It's a fundamental difference in philosophy. While Sharpe uses total risk, which is standard deviation, CAPM strictly uses beta. CAPM argues that since unsystematic risk can be diversified away for free, you shouldn't be evaluating managers based on total risk. You should only evaluate them based on the systematic beta risks they took on.
So CPM calculates what the expected return of a portfolio should have been given its specific beta.
Exactly. The formula states, expected return equals the risk-free rate plus beta multiplied by the market risk premium, which is just the overall market return minus the risk-free rate.
It builds a theoretical baseline. So how do we evaluate the human manager using this?
We look for alpha, which the text calls the abnormal return. You take the actual real-world return the manager achieved at the end of the year and subtract the theoretical expected return that the CAPM formula says they should have gotten based on their beta.
And if it's positive?
If the resulting number is positive, the manager generated alpha. They legitimately outperformed the market through superior skill or stock selection. If it's negative, they destroyed value relative to the risk they took.
I have to ask, if APM is so widely taught, why does the text also introduce arbitrage pricing theory, or APT? Aren't they trying to do the same thing?
They are, but APT attempts to fix APM's biggest conceptual flaw. CAPM relies on a single factor, the overall market index. It assumes that the single market beta captures all systematic risk. APT argues that the global economy is way too complex for a single factor.
It's too simplistic.
Right. APT proposes that expected returns are actually driven by multiple overlapping macroeconomic factors, like unexpected shifts in inflation, sudden changes in the yield curve, or shocks to industrial production. APT builds a complex model where an asset has a specific sensitivity or a mini beta assigned to each of these individual statistical factors. It's a much more rigorous, granular approach to defining risk.
It sounds like it requires immense computational power compared to CAPM.
It does, which is why multi-index models are primarily used by advanced quantitative hedge funds rather than retail investors.
We are nearing the end of the curriculum, and we have to discuss the philosophical godfather of this entire unit, Harry Markowitz and his framework for risk-return analysis.
Markowitz essentially invented modern portfolio theory in the 1950s. Before him, investors basically just tried to pick a list of good individual stocks. Markowitz proved mathematically that analyzing securities in a vacuum is dangerous. You must analyze the portfolio as a holistic, living organism. It's the mixture, the allocation weights, and as we discussed earlier, the precise covariance between the assets that dictates survival.
For the exam, there is a specific definition students must have memorized verbatim. What is an efficient portfolio?
An efficient portfolio is a portfolio that provides the absolute highest expected return for a given level of risk. Or, viewed from the other side, it provides the absolute lowest possible risk for a given targeted return. It is mathematically optimized.
And Markowitz took this a step further with the efficient frontier.
Yes. If you have a universe of 1,000 stocks, there are millions of ways to blend them. But if you use a supercomputer to calculate and plot only the strictly efficient portfolios on a graph mapping risk on the x-axis and return on the y-axis, those optimal portfolios will form a distinct, continuous curved line. That upper boundary line is the efficient frontier.
What happens if a portfolio lands below that line?
If a portfolio plots below the frontier line, it is fundamentally suboptimal. It means the manager is taking on too much risk for too little return, and they could mathematically improve their position just by reallocating their existing assets. Any rational investor should demand to be positioned squarely on the efficient frontier curve.
As we wrap up this massive deep dive, the text leaves us with one final comprehensive illustration 8 regarding KRC Ltd, to ensure students can tie all these separate mechanics back into a multi-year historical reality.
It's the perfect capstone exercise. It gives you 6 years of historical stock prices and dividend payouts, and asks you to find the simple average rate of return.
And the key here is remembering that total return requires combining both sources of value creation every single year before you average them.
Exactly. For a given year, say 2011, you look at the price change from 2010 to 2011 to find your capital gain percentage. Then you take the 2011 dividend and divide it by the beginning 2010 price to find your dividend yield percentage. You add those two percentages together to get the total return for 2011.
And you just repeat that.
You repeat that meticulous process for 2012, 2013, 2014, and 2015. Some years are massive gains. Some years might be negative due to price crashes. Finally, you sum those 5 distinct annual returns and divide by 5 to find the arithmetic average. It proves that you can dismantle a multi-year timeline and account for every penny of yield and capital fluctuation.
We have covered an absolutely immense amount of theoretical and mathematical ground today. If you are sitting there listening to this, preparing to walk into that exam hall, take a deep breath. You now understand the underlying architecture of the formulas. You know why we square deviations. You know the difference between the arithmetic lie and the geometric truth. You know how covariance acts as a shock absorber.
My final piece of advice for your test prep: respect the vocabulary. The examiners will try to induce panic by rotating synonyms. Take a breath and actively distinguish between systemic risk and unsystematic risk. Remind yourself constantly of the fundamental difference between standard deviation, which captures the total chaos, and beta, which isolates only the macro market risk. If you keep the vocabulary straight, your intuition will guide you through the math.
We started this hour talking about the weather forecast, how we expect a sunny day based on the models, but the realized return might be a sudden thunderstorm. The uncertainty is the risk.
And we spent the entire time discussing how to mathematically engineer an optimized diversified shelter to protect your capital from that inevitable storm.
But I want to leave you, the listener, with a final, somewhat provocative thought to mull over as you close your textbooks today. We talked earlier about 2 massive threats: longevity risk, the terrible danger of outliving your capital and systematic inflation risk, which is the undeniable reality that the purchasing power of fiat currency decays relentlessly over time. It is unavoidable, no matter how perfectly you diversify.
Right.
So it raises a philosophical question built entirely on the rigid definitions within your textbook. If the macroeconomic system practically guarantees that holding cash will lose substantial purchasing power over a timeline of decades, is the pursuit of a completely safe, risk-free investment strategy actually the biggest, most catastrophic financial risk a long-term investor can possibly take?
That is the ultimate paradox of finance, and a question every portfolio manager has to answer for their clients.
Best of luck on the exam. You're ready for it.